In this video we're going to go through my DCF model for Netflix, which I've updated based on the new information and projections from the 2022 Quarter 2 earnings report. So I'll cover the usual contents for these videos. First of all, we'll start with the assumptions and base case forecasts. I'll also cover off the changes in this model to my previous model. We'll then have a look at the DCF model for the base case scenario and the IRR calculation. Then we'll have a look at the bear case scenario, bull case scenario, and just finish off with the three different scenarios side by side. Assumptions then, we've got a tax rate of 12%, discount rate 7.4% and perpetual growth rate of 1.5%. EV to EBITDA multiples 13. The transaction date 27th of the 7th, which is the time of the analysis, and the fiscal year end for Netflix is 31st of the 12th. At the time of the analysis, the current price is $222.18. The shares outstanding is 444 million, debt is just under 17 billion, and cash is just under 6 billion. The changes to these assumptions from the last model, we've got revenue forecast is lower based on the management and analyst projections from the quarter 2 earnings. EV to EBITDA exit multiples increased by 1 to 13. CapEx has increased slightly to cover costs of inflation, and the discount rate is lower due to the WACC calculation and the change in cost of equity. And the revenue growth forecast, then we can see there's a big drop in 2022 to 6.5%. This increases to 9% in 2024 and then decreases to 8% in 2026. This converts to unlevered free cash flow with a drop in 2022 to 4.8 billion, which then increases to 6.7 billion in 2026. So looking at the DCF model details then, if we start with the terminal value, we've got an EV to EBITDA terminal value of 111 billion. Perpetual growth gives us 116 billion, which is an average then of 113.5 billion. Bringing the terminal value across along with the adjusted unlevered free cash flow, we get a net present value of 105 billion. Add cash, take away debt, that gives us an equity value of just under 94 billion. Divide that by the shares outstanding, gives us an equity value per share of $211.22. With a market value of $222.18, that gives us a downside of 4.9%. Now if we have a look at the internal rate of return, we can take the market cap, which is just under 99 billion. This time we'll add debt, take away cash, that gives us an enterprise value of just under 110 billion. We can then use this as our investment amount, bring across the adjusted unlevered free cash flow, that gives us an internal rate of return of 6%. Now we can have a look at some sensitivity analysis here. If the stock price increases to $266.62, the internal rate of return will only be 1.8%. If the stock price decreases 20% to $177.74, we'll get an internal rate of return of 11.3%. That model was based on the base case scenario. What we'll do now is we'll just have a quick look at what a bear case and a bull case scenario might look like. Starting with the bear case scenario, then we've got revenue growth forecast of 2022 at 5.5%. This is the same in 2023, which then gradually increases to 8% in 2026. This converts into unlevered free cash flow with a drop in 2022 of 4.4 billion, which steadily increases to 5.8 billion in 2026. This fed into the DCF model gives us an intrinsic value of $183, which is actually a downside of 17.6%. The internal rate of return is 2.8%. If there was a stock price increase of 20%, the internal rate of return would be negative 1.3%. If the stock price drops 20%, we'd get an internal rate of return of 7.9%. For the bull case scenario, we've got a revenue growth forecast of 7% in 2022. This increases to 10% in 2023 and then stays static. This converts into an unlevered free cash flow for 2022 of just over 5 billion, which then increases to just under 8 billion in 2026. This gives us an intrinsic value of $252.82, which is actually an upside of 13.8%. The IRR is 10.3%, and this drops to 5.9% if the stock price increases 20%, and if the stock price reduces 20%, we get an IRR of 15.8%. Looking at the three scenarios side by side, then we can see there's only the bull case scenario that gives us an upside, with the bear case scenario giving us significant downside. Based on the assumptions in these models, Netflix will not be getting added to our portfolio anytime soon. Thanks for watching the video. If you did find it useful, please give it a thumbs up and subscribe for any future model updates. Also, you can visit us at bullybear.com for more detailed analysis and other useful information. Thank you.